Well, hello and welcome to the special series that's called Global Mantra, the show that we bring to you from the City of London, profiling prominent fund managers and getting their views on the global market situation. Joining me on the show once again is Bart Turtelboom, who's the co-head of emerging markets at GLG, a hedge fund that manages over $20 billion and is owned by the Man Group. Bart, it's so good to have you once again on the show. Thanks very much.
Great to be here.
Yeah. Let's talk about your EM outlook for 2012. And I was just going through the report where you have mentioned that you see the current environment as very similar to 2008 and 2009. Does that, in a sense, give you the feeling that if we see a rebound from here, we can actually regain the 2010 peaks that the market saw?
I think it's an absolute distinct possibility that happened. Just like in 2009, we are coming out of a crisis, which was effectively a crisis originating in Europe and in the US. Emerging markets are doing, on the whole, fantastically well. Commodity prices remain strong. Macroeconomic policies remain very robust. And I think we're in for a sustained rally in emerging markets assets, particularly because I have a feeling that very few investors have significant risk on. The risk profile is very low. The fundamentals are very strong, and I think we could be in for a good ride.
But you have also mentioned in that report that we expect EM indices to continue to fall until the size of the impending recession becomes more known and more priced in. How much of the fear or the risk you think is priced in now, which will cap the downside and call for a more sustainable rebound?
An inordinate amount of fear is currently being priced in the market. When you look at the emerging markets currencies, they're still very weak compared to levels that we've seen on average over the past 4 or 5 years. We've seen a moderate sell-off, but nevertheless a sell-off in emerging markets debt. On the equity side, we're coming out of a period of very sustained carnage where emerging markets equities once again underperformed G7 equities last year. And all this is still very much priced in, and we expect it to rebound.
So this policy-led recovery that you expect, when do you see that happening in 2012?
Towards the end of Q1, early Q2, very imminently. High-frequency economic indicators have been quite weak in emerging markets on the back of the slowdown, particularly in Europe. But we expect that to turn around rather quickly.
And you think that the force of liquidity would be strong enough to take us all the way to our 2010 peaks?
Absolutely. In a sense, we are in better shape now because policymakers in Europe and in the US have been much more proactive. I think the LTRO from the European Central Bank late last year, which may be followed up by a second tranche over the next couple of months of 1 trillion, is a watershed event. It introduces a tremendous new source of long-term liquidity in the market space, which is going to find its way into risky assets, including emerging markets.
So from a long-short strategy perspective, within EMs, what are the opportunities that you're sizing up?
Brazil, which was a significant underperformer in the first half of last year, looks quite compelling. The rate cycle is going to be supportive of equities. The currencies is weaker. Rates are lower. So on the whole, Brazil is one of our top picks. In Russia, we're going to have the elections very soon. We expect no significant surprises there. And Russia comes out of a year which was the best year in its economic history from an oil price perspective. So again, we are seeing very significant upside there.
You have stated in your report that you expect the to go long essentially in curves that have already priced in rate hikes and are yet to price in rate cuts. Now, we haven't really, for some of these economies, especially for India as well, we haven't really seen the rate cut cycle begin. Does that mean that the sovereign bond in India is very lucrative?
It's an attractive investment proposition from a fundamental creditworthiness perspective. And as you say, we still need to see the rate cycle turn in India. Obviously, inflation has been quite sticky, which has been a limiting factor for the central bank to cut rates. But at some point this year, I think this will happen and we will see it. In general, in emerging markets, on the rates front, I think it's going to be a mixed bag. Some countries were very proactive last year. And there, I think we could actually be closer to rate hike than rate cuts. But others, like India, I think the cycle still needs to come.
So does that mean that today government bonds in India are a buy, or is an investment class that you would look at going long on?
Absolutely.
Okay, and what kind of return expectations do you have when you see yields trading at 8.5%?
I think yields could rally relatively easily another 100 to 150 basis points, and add to that the currency appreciation you gain, and you're looking at a very attractive risk reward.
I'll quote this line from your report. You're saying, however, at this point in time, the reward per unit of risk has seldom been higher, in our opinion.
I think that absolutely is the case. We're looking at valuations. We are looking at macroeconomic and microeconomic outlooks. You've just referred to the development of the corporate debt market in India. That in and of itself is will give an enormous boost to the equity market.
But could you relate that with an example on how that impacts the return expectations, and how do you balance that risk return equation in an environment where there's so much uncertainty?
You're entirely correct that if we were to go through another crackdown lower in European and US markets, it's very unlikely that emerging markets are going to shine in that context. So that systemic G7 risk remains there. However, as I already mentioned, the LTRO from the ECB, I think, has taken the sting out of that equation very significantly. And in light of that, the natural resources cycle remains intact, the gold cycle remains intact, the currency appreciation story remains intact, and all these things will be very supportive for emerging market equities.
But we were talking about the key risks associated in this sort of a market environment, and the one that comes to mind through your report is the correlation that asset classes have at this point. You believe that that correlation is likely to subside, especially between emerging markets and developed markets. When do you see that happening, and what will be the overall impact of that?
I expect it to happen relatively soon, towards the end of the first quarter or the second quarter of this year. The main factor will be that the tail risk of an uncontrolled spiraling out of control of the sovereign debt crisis in Europe is becoming less and less likely on the back of the policy actions that we have seen. And once that is taken out of the equation, fundamentals and technicals are going to reassert themselves. And from that perspective, I do expect a significant decorrelation of what's going to happen in emerging markets versus the G7 very soon.
What about the risk of sovereign bankruptcies or defaults coming out of Europe that we've talked about for many months now? How much of that is priced into the market, and how much of that can impact sentiment now at this stage, maybe perhaps even 2 months down the line?
I would say that the restructuring of Greece, voluntary or involuntary, which is currently being worked out, is very much priced in the market. I think that the liquidity provision by the ECB is going to allow the other countries which are dealing with leverage issues in Europe to use the next 2-3 years to embark on a program of macroeconomic stability and structural reform, which is going to be very supportive of those economies. So I think most of the fear is still priced in. However, there are still quite a few risks hanging over this. The primary one being the deleveraging of the banking system that we are witnessing, particularly in Europe, but also in the US, which is putting pressure on risky assets.
Okay, so you have also stated in your report that defaults are your risk case scenario for Europe, not your base case scenario. What is your base case scenario for Europe or the European situation in 2012?
Our base case scenario is as I mentioned to you, a restructuring of Greek debt, the implementation of structural reforms and fiscal tightening in the periphery of Europe, a euro within that context that we don't expect to be overly strong but also not collapse, and most importantly, a growth outlook for core Europe, Germany, Holland, Belgium, Luxembourg, and northern Italy and France, that is actually going to be quite supportive and potentially surprise on the upside.
A lot of countries are going through elections this year. So the undertone is going to be determined by what happens at the political front for most of these regions. In that light, do you think that 2012 can actually end up being a damn squib, where returns actually don't match expectations?
It is possible. However, I would argue that when you look at the political transitions that are currently going to take place in emerging markets, whether it's China, whether it's Russia, whether it's some Latin American countries, I think the policy continuity that we can expect there, regardless of who wins, is actually much higher than what we would, for instance, be witnessing in France, the upcoming election in France, or the upcoming election in the US, where there are genuine, deep philosophical differences on how to tackle the economic climate that these countries have found themselves in. Again, we're going to have these transitions in emerging markets.
But wouldn't you think that the markets would be a bit nervous about these political events and thereby not move in any direction but rather be range-bound?
It's possible. We've seen it in December in Russia. Putin is running to become president. There were demonstrations in the country, totally unexpected, certainly for most foreign observers. The markets had a bit wobble on the back of it, but the fundamentals rather quickly reasserted themselves.
Okay, so how would you be looking at maximizing your returns in this year and capping your downside risk?
I think the single biggest tool that we continue to use to cap our downside risk is to stick to very liquid instruments, be they currencies, be they equities, be they bonds. I think the risk premium for illiquid assets, illiquid exposures, does not justify dabbling in them. The world, to your point, does remain a very uncertain place. We are more constructive, but the risk factors we've discussed here are clearly there. And in light of that, the ability to turn around a portfolio, if they were to materialize more than we expect, is absolutely critical to our risk management.
What about political transitions in the Middle East and how that can impact commodities, especially oil, which is now above $100?
It's generally difficult to be constructive on the Middle East more in general. We are having the drama unfolding in Syria. We are watching a very haphazard political transition in Egypt, which clearly has significant tail risks embedded in it. We are having the rest of North Africa finding its footing itself after the revolutions from last year. These are processes that are going to take time. These are processes that quite likely are going to require a very significant depreciation of some of the currencies, pressures on reserves. We are there having a good old-fashioned emerging market style political and macroeconomic uncertainty colliding to really create a lot of risk with not a whole lot of upside. Now, obviously, all this will be quite supportive for oil prices. We've seen the tension between Iran and the US recently. That is supportive for the regimes that produce the oil in the region, but does not in and of itself offer tremendous investment opportunities for us.